Hey, my name's James Nicholson and welcome to my channel. In this video, I want to talk about why hasn't the housing market crashed? Because so much is against it. We've got high inflation, we've got 14 consecutive interest rate rises. We've had all of this stuff that's been hitting us for a couple of years now, yet the market is still fairly robust. Now, there are pockets of areas where prices are down significantly. I did a video this week where I talked about London prices in some areas are down 22%. Do go and check that out if you haven't seen it already. But on the whole, the market is fairly robust with not really any signs that the market is going to start crashing down at any point. So I want to talk about what's keeping the market high and is it going to stay like that? That's what we need to decide together. So before we jump into this, as always, if you haven't done already, do subscribe to the channel over there and hit the bell notification. We're on the way to 24,000 subscribers. We're a smidge away. Have a look around this video. You can see how close we are. And while you're here, smash like, tickle like, do something to the like button. That really helps us with the YouTube algorithm. Thousands of you do it every week, and that's why we get so many views. So I appreciate everyone that takes a moment to do that. So let's have a look at some points. Well, the market is down, and on an annual basis, it is down around 2.5%, which is not great, but not too bad. And in March, the average house price with the ONS data was 282,776. So 2% is not great. No one really wants to have their price of their property go down. But as an investor, it doesn't really concern me 2% because I only buy properties myself, and I'd show you that you should only buy properties where you can add value. You should be able to add at least 10 or 20% value to a property. Otherwise, it's not worth taking on. And I'm talking about doing refurbishments, adding extensions, converting garages, that sort of stuff. So here's one of the main reasons prices haven't crashed, and that's because of stress tests. So 2008, I was an investor then. I've been investing since 1999. I can recall going to my mortgage broker maybe around 2005, and they just asked you how much money you earn. Nobody confirmed anything. It was called self-certification mortgages. You literally could just tell them how much you earn. And I know people that were builders that were struggling that were borrowing hundreds of thousands of pounds. They were saying that their salary was significantly higher. Now, that's why the market crashed, because a lot of those people borrowed money and they couldn't afford to pay it back. In fact, some lenders were lending, say you had a 100 grand house, they would lend you 110% of the value because the market was so hot. So you bought a 100 grand house, they'd lend you 110,000 pounds. So as soon as the market went down, let's just say it went down 5%, you'd be 15% in negative equity at that stage. And a lot of people just gave the keys back. So following the financial crisis, it became law that they had to do really stringent stress tests. Getting a mortgage now is tough. You know, I'm constantly getting mortgages, either remortgaging my property portfolio or I'm getting new mortgages. And every single time you've got to jump through all these hoops. They're checking all your bank statements, they're checking your income, and it's a lot of work. And so because they've got stress tests, they stress tested people to make sure you could afford the property, even when the rates were at 1%, that you could afford it at 6%. So a lot of people are affording it at 6%, and that's why that's working. Next is the mortgage charter. Maybe you don't know what that is. Hopefully you do. The mortgage charter came out about a year ago, and I think it was December actually, and it was basically because we've had high interest rates, we've had high inflation, the government came out and kind of twisted the arms of the banks and said, we want you to allow people to go interest only on their mortgage if they need to for 6 months. Millions of people did that, and that probably reduced their payments by around 20-25%, which meant that they got some affordability back. And with all the inflation and stuff like that, it just meant things were a little easier. What also happened was banks were not really permitted to do repossessions in that time. They had to give you more time to catch up and get back on track, which has helped a lot of people. And the mortgage charter, I think, was a good policy that they had in. Next is property. I'm not going to put this on here, is a necessity, right? So yes, we've had tough times. Yes, interest rates are up. But what you're going to cut back first on is your holidays. You're not going to go to Dubai and spend all this money on lavish holidays, but not pay your mortgage, right? So the mortgage is a priority bill, and that's why people are paying it, and they're cutting back on other stuff. They're cutting back on new cars. They're cutting back on clothes, restaurants. They're cutting back on holidays and stuff like that. So it is a necessity. That makes a big difference. Next, this is a big one. It's a slow market at the moment. Now, this is on both sides of the market, meaning there isn't like a billion buyers out there, but there's also not a billion properties for sale. They're actually quite matched up quite well and equal at the moment. There's a lot of people just sitting on the sidelines, waiting to see what happens. They don't need to sell at the moment. And that is a big thing. If you don't need to sell, you don't need to take a discounted price in order to sell. And that keeps the market a little bit more buoyant. Next is low-end properties. So what's happening is the shift is that the lower end, the 100 grand, the 50 grand, the 200 grand, the flats, the semi-detached houses, those are still selling. That market's busy. It's the high-end stuff that's not doing particularly great. So it's downsizers and people moving into and buying buy-to-lets that is keeping the market going really well. Another thing that's keeping the market from crashing at the moment is pay growth. Now it is higher than inflation, which is good. Not so good for bringing interest rates down, but pay growth is meaning people, every single time they get even a smidge of a pay rise, they're getting slightly better off. Not quick enough, in my opinion, but it is moving in the right direction, and that is good. Next is longer mortgages. I said this would happen. You can go and check. There's a video about it. Over a year ago, I said this would happen. I said, I believe that longer mortgages will help keep prices higher. It's there for everyone to see, right? And what I mean by that is that a standard mortgage used to be 25 years. But this year, we already had some, but we're getting more of them now where banks will create longer term mortgages, meaning you can borrow for 35 years. 40 years is the maximum. And I reckon that you'll see 50 years, 60 years, 70 year, 80 year, 100 year mortgages that pass down to your family. And so those types of mortgages mean you're going to pay significantly more in interest, but your monthly payments will go down significantly, meaning you can afford a bigger property. That is going to help keep the market up. That is going to get some people into the market that couldn't afford to buy before. So those are very, very good as well. Next is there is plenty of buyers. So there's loads of buyers still around. As I said, it's matched up to the number of sellers at the moment. If you get a scarcity of buyers, you get a lack of buyers in the market, then sellers have to drop their prices significantly in order to get a sale. Having lots of buyers in the market is still very, very good. And that is really, really good. Now, also, you've got a lot of people as well with no mortgages. So if you've got no mortgage, you don't need to sell at a loss. If you've got no mortgage on the property, very unlikely at any point that you'll get desperate to sell that property. Some people, they'll see the market is moving down 2.1%. They'll just wait. They'll just say, you know what? I don't need to sell this year. I'll wait until the market recovers. So there's all of this stuff that's keeping prices up. Now, officially, in real terms, house prices are down 2.1%. But with inflation accounted for it, they're down around 12-15%. So they are becoming more affordable. So they have gone down because the value of a pound is worth less than it was 2-3 years ago, but it's still a better way for the prices to go down. And so the market might crash. It might go down 15-20%, but it hasn't yet, and it kind of should. A lot of people thought it would. It didn't. who knows to say what's going to happen in the next few months. Let me know in the comments what you think. Is there anything else that I've missed? What else could be keeping the market high? I'd love to know your thoughts. Do smash the like button. Do share this video with somebody. Subscribe to the channel and go and check out some more content on the channel, including this video right here.